Well, here we are. Good evening, and another Tuesday evening, another show. We're in pre-show mode just for a few moments. I'll just acknowledge a few of the people on the chat. Bondi Steve, hi, how you going? Nice to see you on there. Other saying this should be interesting. Should indeed. I'm looking forward to tonight's discussion. Hi, Vanessa, how you going? Fraser says, can you tell me when the markets will crash? Well, good question. Is there a law for house prices to fall? We might discuss that. It's from Smooth. Hi there, good to see you on. Aaron says, another discernible watcher. Luke says, hi. Fraser says, just abolish the central banks. Well, end the Fed and the RBA. Hi George, good to see you, and quite a few others there that I won't bother to go through, or we'll spend all the time in pre-show mode rather than in main mode, but good to see some new people on as well. Bossman, hi, good to see you. Michael, nice to see you there too. So thanks very much for checking in. Without further ado, let me take the pre-show off and we will run the intro. See you in a second. Well, good evening and welcome to this live stream event on the 26th of October 2021. Martin North from Digital Finance Analytics here. Great to have you on. Thank you very much for spending some of your Tuesday evening with us. And I have Damien Klassen queued and ready to come in just a moment. As normal, just before he does come in, I will just run my normal warning. This isn't legal or financial advice in any way. It's just a general conversation. Do please play nice in the chat room. We do moderate the stream. This is as at the 26th of October if you're watching in replay. If you want to ask a question, make sure that you put at what the world into the question to get my attention. Otherwise, I might miss it. But I do encourage you to share ideas in the chat with each other, and quite a lot that goes on. I don't promise to follow every line of chat, but if you use at what the world, there's a good chance that I'll be able to see. Super chat has been enabled, and that means that if you want to make sure your question goes to the top of the queue, you can use Super Chat for that. Or indeed, if you'd like to make a general contribution to help us run the show, that would be great too. We don't do this because we're trying to make money out of it. We're doing it because we think it's important, but there is cost, of course, involved in just making all of this happen. So with that introduction, I'll get that off. And I'm going to now push my button and see whether Damon appears. Hello.
Martin, how you going?
Yeah, good. It's working, I think.
Excellent. Well, at least we can hear. Yeah. Hopefully your listeners as well.
Yeah, exactly. Well, thank you very much for coming on and spending a bit of time once again with us. Just before we get going, why don't you just do your normal introduction, seeing as people probably will be aware, but some may not be. And of course, there is the What the World Fund connection with Nucleus Wealth. Yeah,
sure. So, when you say the normal one, I'm trying to remember what that actually is. So look, we run a fund, both superannuation money and just ordinary investments. It's what's called a core fund. So the word nucleus is this idea that we run these sort of lower risk assets in terms of being large cap shares, both international and Australian shares, Australian government bonds and cash, and that sort of sits at the centre of the portfolio and just provides that lower risk exposure to the market. And we try and lean into the cycles. So we either, if we think the markets are running ahead of themselves, then we'll carry a little bit more cash, a little bit more bonds, and then as they fall back, then we switch back into it. We also have some recently launched lower cost ones as well, where we don't actually make any bets on it. We just it's effectively similar to an exchange traded fund, but the benefit of what we're doing is because all the shares are held in your own name, all the tax benefits come to you, and you can also go through and screen the portfolios for things like ethical screens. If you didn't want any gambling stocks in there, you can cut them out, or if you weren't interested in anything to do with carbon, for example, you can just cut them out of the portfolios. So yeah, that's what we provide in a nutshell, and we provide in concert with Martin, the Walk the World Fund. it's a shared venture.
Yeah, absolutely. And there's a walktheworld.com.au, which if you want to go and have a look at that gives you all the information about the funds. And, the reason that I've connected with Nucleus is because they've got the most transparent of anything that I've ever seen. A lot of options and choices, and compared with most of the big funds who basically close the book and don't tell you anything about what's going on, it's completely transparent. Good times and bad times, right?
Yeah, absolutely. Painfully transparent, as I say, when you're running the money yourself, and so every stock you can see what's in there, why you own it. There's a quick summary for each stock, and we put out regular reports at least monthly for performance reports, and we blog probably once or twice a week as well, just to sort of keep people up to date with, and have our own podcast as well. We run once a week just to keep on track of what's happening with all the portfolios.
Yeah, absolutely. And I think the social media aspect of it's quite interesting, right? Because there's quite a lot of communicating of ideas, and again, a lot of the big funds don't do any of this, right? So you can get inside your head a bit and see and understand what you're thinking and why you're doing what you're doing.
Yeah, and also sometimes people don't agree with what we're saying, and at that time they might move into just the assets themselves, or they might decide to lower the amount they're giving to us and invest more somewhere else, and then with the idea that we're perfectly happy for them to do that, with the view that we keep the transparency up, and then when they do agree that they can move back in, or at least organise their other assets around what we're doing to cater to their own views.
Absolutely. Now, what I want to do is to talk about the mirages tonight, right? Because I think we are in a situation where there are lots of mirages, the deflation or inflation mirage, for example, right? The China property fallover, Evergrande fallover not situation, right? The supply chain going to bounce back, everything's going to be fine, versus this is actually going to drive massive amounts of inflation and multi-year disruptions. I mean, almost wherever you look, I don't think I've ever seen a time when there are so many divergent opinions about what the hell's going on.
Exactly. Yeah. No, I concur completely. So let's jump in, because I think I'll tell you what my thoughts are with them. But again, for some of these, I do think there's a chance it goes the other way. I don't, I'll have my view, and I might be 70% certain this is what happened, but there's still a 30% chance it could go the other way. And so, with a lot of these, there's uncertainty, and the big disclaimer as well I put on everything I've been saying for the last year or so is that we're driven by central banks and governments. So we have a view on something, but if they, we have a view on Evergrande and what's going to happen. But if the Chinese government can come out tomorrow and change that completely.
And that really is the point, isn't it? That there is the risk of policy mistakes, probably more so than ever before, from a number of central banks and beyond, because basically they're holding all the cards, and they've been playing the cards for at least the last decade, right? And those cards are getting bigger and bigger because they have to actually throw more and more money into the furnace, as it were, to keep the fire going. But it also means that the risk is building that somebody along the way is going to make a mistake, and if they do, it could be a big one.
And also that when they're doing more of a guiding role of here's we're just here to the herd sort of moving forward, and we're just getting the stragglers and tapping them in, and now they're starting to trying to lead the herd themselves in the direction, and really sort of they're doing so much more than what they were doing 5-10 years ago in terms of central banks, and so there's just so much more scope to make errors, because if your job is just to sort of keep it within the bounds, then that's much easier than actually saying no, we're trying to force everyone in this particular direction, and this is what we need everyone to do. So
let's try and sort of corral some of the mirages, right, and sort of tick them off one by one, and perhaps try and explore them. Where do you want to start? Which mirage do we want to pick off first?
Let's start with inflation, because that's the biggest one, and I think you hear stagflation is what we hear, from most of the Wall Street banks seem to be, talking that up, and it seems to be talking, as if it's a foregone conclusion for some of these, and that's one where I'd certainly disagree. There is a potential that it keeps, we get more stimulus, governments start spending more money, we roll into the infrastructure spending, and it does eventually build into wage inflation and then genuine inflation, but we're so far away from that at the moment. And I guess we wanted to try and isolate the difference between what's inflation caused by short-term supply issues and shifts in demand versus what is structural inflation that's going to be lasting, for a long time.
And that's the question of stickiness, isn't it? Sticky inflation versus non-sticky inflation, as I understand it.
Yeah,
right?
Yeah, exactly. So I've got a chart I'll get you to throw up, which is just this is one that run by the Atlanta Fed in the US, and I've pulled out their 3-month annualized chart. Now there are lots of different versions you can do of these, but basically they split everything up into flexible, which is your things like your fruit and veg and your gas prices and those types of things, and then the sticky ones, which is the prices that really don't change much, things like your rents, healthcare costs, those types of things that are a lot more steady. And so you can see pretty clearly from that one that the sticky inflation, while it rose a little bit, really didn't sort of get that high in that, and a lot of that was that base effect from the prior year, that the prior year had fallen, and it was just sort of showing a bounce coming out of that. Whereas that flexible inflation, that's really where you can see that was the part where it's peaked at, on 3-month annualized rates of sort of, over 25%, which basically means, 6% in a quarter. So, but then that's, as you can see, quite decisively toned down. So whether it does keep there, because we have got this another energy push, so it's possible there's another little tick up as energy sort of hits us over the next month or two. But I do think that immediate phase that most people were worried about has passed, and a lot of that was this whole switch from from people buying services to people buying manufacturing. So as part of the everyone's locked down in pandemics, or at least you're limited in terms of the travel they can do and the amount of services. And so people went out and spent a lot more money on manufactured goods. And that then led to shortages and just supply chain constraints. And plus, and that's where I think a lot of the price pressures have come. They're not all gone yet, but they are passing. And sort of bit by bit, we get to see that sort of happen.
And it's interesting, I think it's the Atlanta Fed who publishes their forward growth expectation for the US, and I think they keep forecasting it down and down and down, don't they, right? So,
yes.
Every couple of weeks it's gone down low. So their growth rate now is way lower than they were thinking even three or 4 weeks ago.
Oh, the GDP now? Is that that's the one? Yeah, that's right. And so, and then there's a very similar index you get out there called the Economic Surprise Index, and a few different people do one of them, which is basically just saying, what were the forecasts for particular measures, and then where did it actually come in, and that generally oscillates between everyone sort of positively surprised, 6 months ago, and that also has flipped to generally negative economic surprises coming through. So that's on that side. I will hasten to add, though, that on the earnings side, the US reporting season has sort of just kicked off, or US and European, for the third quarter. You don't get that in Australia because Australian companies generally only report every 6 months. But you do get an interesting look into what's going on in terms of the companies there. It's always hard to tell from looking at the headlines what's really going on. I find I need to really dig into the numbers myself just to work out, because what companies tend to do when you get to a reporting season is they'll say, they thought they were going to earn $1, and then they get pretty close, and and what they do is they decide that they work out that, oh no, we're actually not going to earn $1, we're only going to earn 90 cents. And so they go out and tell all the analysts, hey, we're only going to earn 90 cents. And so the analysts all downgrade their forecasts to 90 cents. And then the company actually comes out with their result, and it's 91 cents. And so for some people, they go, oh, that's a beat. The company beat its expectations. Like, well, it beat its expectations because it lowered the bar and then it jumped over the lower bar. But so that often confuses things. So I tend to jump in and just say, well, look, let's have a look at analyst forecasts and see what forecasts are doing on a year-by-year basis. And they're pretty much steady, which is actually a good result for, ordinarily the average reporting season. You actually do see forecasts start to come down. Analysts start too optimistic, and then gradually work their numbers down over time. So the fact they're steady is a good thing, but they're certainly not rising at anywhere near what they've done for the last sort of 3 reporting seasons. We really got these massive increases in earnings, which is why earlier on in the year we were actually pretty happy owning stocks with a view that, look, they're expensive, but you're getting these earnings rises coming through, and so that means that they're getting less expensive by the day. Whereas at the moment, they've sort of gone away. So I wouldn't say that would particularly picked on a direction just yet for the earnings. But the initial things they're certainly nowhere near as good as what they've been earlier on in the year.
And it's interesting, look at HSBC, for example, who I think reported quite recently, right? A massive increase in profit, but only because they basically had made huge amounts of provisions which are then reversed, right?
Yeah.
So it's not real. It's not real growth. It's actually just accounting for shenanigans.
Exactly, which is why when you look forward at the 2022 numbers or the 2023 earnings, you get a better view because that's where people will go, okay, that's great. You wrote that all off, but that's a one-off trick. You're not going to be able to do that. So when they do their forecasts for the following year, you don't get that. And actually, that sort of leads as well into that. One of the sectors I've been keeping a close eye on is that the whole transport sector, and I've just found quite extraordinary when you look at the numbers that are being reported by these ones, because we've seen container shipping rates have gone from $1,000 to $2,000 to get from China to the US to like $10,000. They're up, whatever you call it, somewhere between 5 and 10 times higher than what they've been in the past. Is you look at the companies involved, and that flows through into the trucking as well, and what you see is that, profits are up, whatever, 20, 30, 40, 50%, bucket loads for profits. Sales are up, 10 or 20%. But then when you actually dig in and you look, the volumes have actually fallen, and they've got through these massive price rises. And when you talk to the people involved in it, what tends to be happening is it's a bit like there's a traffic jam out there. So all this volume of goods, the extra volume of goods that everyone was ordering, means that the ships can't get into the port as fast as what they used to be able to, and so they've all started to queue up. And then on top of that, there's all these other tiny little things that are coming into the mix. So there's there's been people sick, so from COVID or in quarantine, so it sort of reduced the workforce a little bit. There's been the extra volume of goods means that, and you're stuck in the traffic jam, and it's the part about where if you had, I'll use a freeway example for people. Maybe there's 10,000 cars an hour going through, and that's fine. Everyone gets to go 100 kilometers an hour, and then it goes to 12,000 cars an hour, and all of a sudden everyone slows to going 15 kilometers an hour. It's that type of thing where the trucks that are taking the containers in and out of the ports are finding that whereas they might have done 3 or 4 loads a day, now they're doing 1 or 2 loads a day because there's just too many trucks all queued up and you can't get the right one, and they're shifting around. And so it really is turning into this whole quite incredible sort of slowdown and traffic jam within the US, and trying to work out when that clears is very hard. Like we spoke to companies 4 or 5 months ago, and their thoughts were, look, we're not quite sure when it's going to clear, but it'll be soon. And now they're sort of going, well, we're pretty sure it's going to clear, but we just don't know when. And so there's two elements I'm thinking that could help slow that down for us. One is Christmas. So there's obviously a big shipping amount of goods that come from China across to the US for Christmas, and that's basically coming to an end now. If you haven't, over the next few weeks, if you haven't already got it on a boat, then you're probably not going to get it from China to the US in time. So there will be a slowing in that. And then the other thing is, because of the energy stuff, which we'll talk about soon, I'm sure, in China, a lot of the factories are running a lot slower. And so there's going to be less goods sort of shipped because of the factories are being shut down. So I think there's a few things that might end up clearing that whole batch, and maybe you might even end up in the bit where companies have been trying to put all these extra efficiencies into because of all these problems. They're throwing in all these extra efficiencies trying to clear the backlog. If you actually do clear the backlog, maybe you don't go back to 100 kilometers an hour, you go back to 105 kilometers or 110 kilometers because you've actually got a number of other, just simple stuff like people are packing less in boxes. They're going, we need less foam and less stuff like that, so the boxes can be smaller, so we can put more of them on a ship. And we no longer just throw a bunch of boxes in a container and hope for the best. We got a computer program to work out what are the boxes, how many are we putting on there, and what's the optimal way to pack it so that we can actually fit the whole thing in, and we can fit 20% more boxes than what we used to. And so, a number of those types of things that I think will eventually sort of bite the other end, but we're just not seeing the effects right now because we are literally stuck in a traffic jam.
It's interesting because Biden, of course, has said, right, keep the ports open 24/7, right? Except the ports themselves are actually owned not by governments but by private sector people who need workers. And so, it might be good in theory, but in practice, it doesn't really follow that it's going to make any difference.
Absolutely. And there's a number of ports around Rotterdam in Europe and Shanghai in China and that are pretty much automated. And most of the driving and everything like that is all driverless it's a very easy situation to actually run a lot of this driverless stuff because you can paint lines on the docks to actually tell where to drive and just got to follow the line type thing. It's nowhere near as complex as actually driverless sort of in the real world. And so they could obviously run a lot faster, but the US is quite heavily unionized. And so, and as you can guess, they're not that keen on having their workforce replaced. And so, so there's tensions over there, but you probably will see more automation within the US workforce over time. And so, that's just one more thing. These are just all these pressures that are building up to. But once it passes, quite possibly you get a pretty good snapback in the other direction. But yes. It's the problem of when does a traffic jam end? Nobody really knows what's the proximal thing that actually finishes that traffic jam.
Yeah, absolutely. Well, there are so many varying things, and it's worth saying that the US freight costs and handling costs, even before COVID, were always a lot higher than most other ports around the world, right? I mean, not just a little bit, quantums higher, simply because of the unionization and the lack of the technology investment that's been made in other places around the world.
Yeah, and one of the other big problems they've got right now is that the port in LA, that's the main one where they're having all the blockages. That basically you come straight out of that port and into some of the busiest roads in the US. They just don't have it's just not set up in the way you'd expect to say, well, if the port was somewhere else and you didn't have to drive straight into a major city. You can actually start and off you go if you need to bring it into somewhere in the middle of America. But it's like, no, your very first task is jump on this freeway and sit in traffic for 3 hours before you can actually get out of the city. So, yeah.
Now, there's an interesting chat coming in from Fraser. He said the RBA wants moderate inflation to get rid of the debt, but they don't want high inflation. In other words, it's a balancing act and they will screw up. I mean, that's actually quite insightful because actually, it seems to me that central banks would love a bit of inflation to be able to inflate the debt away. But on the other hand, they've got this target within which they've got to try and operate. So they're facing two directions at the same time. And by the way, if inflation comes and interest rates rise, the costs of government debt will rise. So they're pulling in two directions at the same time, it seems to me.
Yeah. Well, and the big question is, which direction are they going to get it wrong in? So they're going to overcook it or are they going to undercook it? And so I think from the way I'm looking at it at the moment is there's a lot of pressure on the US Fed to start tapering, and I think it'll be too early. And they've got a lot of headline rates that are high, but I think the US Fed is probably predisposed to getting it wrong in the being too aggressive on the rate rises or too fast on it. The RBA is in this really interesting point of now where there's going to be a review, or it looks like there's going to be an international review, and they haven't hit their target for basically ever since the new governor started. And so my guess would be that they would be predisposed to missing on the upside. If you've missed your downside target for the last 4 or 5 years, then and you've got a big review coming, then I would certainly want to be trying to miss on the upside, and it seems as if that's what they want to do. But by the same token, you hear stuff that they do want to try and taper as soon as they can as well. So I don't know. It's an interesting dynamic. Yeah. I think one of the examples I was using is saying, well, Martin, if you want to go work at a central bank, it's a bit like being a firefighter. You go there because you want to fight fires and want to put fires out, and you go there because I want to control inflation. I want to bring inflation down. And now people are telling you, no, Martin, I want you to go light some fires for me. It's like, well, no, that's not what I signed up for. I signed up here to fight inflation, not to create inflation.
And it's interesting that if you look at the structure of the Reserve Bank in Australia, right, it's much more closed and myopic in terms of the people who work in the central bank have always tended to work there, right? And the board that they've got is really not a very experienced board they might have a bit of business experience, but in terms of people who understand, the dynamics of economics. So in a way, there's a risk of groupthink. Certainly, I think in Australia, it's interesting because Adrian Orr in New Zealand has already put the interest rates up once. There's talk they're going to do more of it, and it seems to me that they've got more of a real sense of trying to do stuff. The Reserve Bank seems to me to be sort of a little bit, not sure what to do really.
Yeah, I mean, I would argue that they've that there's a good case for bringing in somebody from externally, not purely because it's good to have different points of view, and I think what you're saying is right in terms of there's a board of very senior people from industry, but they're not the type of people who can prosecute an economic argument, or in my view, they're not people who can prosecute an economic argument to actually push back on what the RBA says. So, because if the RBA says, I think one of the benefits in the US, the way they're structured is they do have multiple different versions of the Fed, and in different places that all work relatively independently. And so when somebody says, I think inflation is doing this or whatever, your Atlanta Fed guy can say, well, this is what my thing's telling me, and your Dallas Fed guy will stand up and tell us, no, we're working on something different, and you can have a genuine argument. But if you're turning up there as a board member and you're the CEO of Woolworths or whatever in your spare time, then you probably didn't have time to go away and do all this economic research and people to actually come up with the argument to then push back on what the RBA is telling you.
Yes, and it's interesting. There's an argument, I think, for having a more devolved central bank, because if you think about the economic conditions in Western Australia versus Queensland versus New South Wales and Victoria, they're all quite different. And actually, in a way, it would be rather good to have some of that more challenging discussion rather than just being, well, frankly, dictated probably by the East Coast, right? Never mind. And through a very narrow monetarist lens as well.
So you're offering Colin Barnett his own currency as well?
Well, they just cut down the dotted line and just move Western Australia away.
Well, that's well, there's a reasonable argument that to be made that because it's so resource heavy, is that let's say Western Australia, if it had its own currency, and it doesn't, not saying you need to kick it out of Australia to have it, but if it had its own currency, then during the mining boom, that would have meant the rest of the East Coast state, the East Coast dollar wouldn't have had to rise anywhere near as much as what it did, and all the manufacturing that we lost and the car industries and all those types of things might not have been anywhere near as much of an issue if you had that sort of separate currency for it. No. So and then they had exactly the opposite problem, where for the last what was it, 2017 to 2020, where their house prices were falling constantly and unemployment was rising, whereas the rest of Australia was like, no, we need to keep interest rates low to push more going because so sorry, keep interest rates at a higher level to stop inflation from getting away, whereas in WA they probably would have been much better off with lower interest rates and lower currency. So there's a reasonable argument there, but I don't know whether you're going to get too many supporters for that, are you?
Probably not, but I think it's an interesting, philosophical perspective in terms of how do you deal with economies that are just so different, right? Cyclical versus not cyclical, one-trick pony versus another trick. I mean, there's a bunch of interesting questions there, and I think sometimes we end up with this sort of compromised, lowest state set of solutions because, that's the best they can do, because it becomes just a sort of a netting off all these different things.
Well, but that's Europe effectively, really. I mean, you've got exactly the same problem with the euro, where the northern, your German economy and your and Netherlands and a few of the sort of northern European ones who are doing quite well, and then the southern European with all the high unemployment rates. And the difference there is, it's pretty hard to find somebody, within countries. Let's say in Greece, getting somebody to move villages is difficult, let alone telling somebody in Greece, no, we want you to move to Germany to go get work. Whereas at least in Australia, you do get a bit of sort of east-west, but it's obviously nowhere near as much as sort of within closer boundaries.
So just sort of bringing this first conversation to a close then, in terms of, inflation, deflation, stagflation.
Yep.
Is it structural, is it not? I get the sense that you still are not convinced that it's structural.
Yeah, that's right. So, and the word I guess it's probably important to define, what do you mean by transitory, and does transitory mean that it spikes higher and then bounces lower? Or is it just a matter of saying that, for me, the key thing to remember with inflation is if you're going to have entrenched inflation, you need to see those prices keep rising. And so if we think that the levels that you've reached in terms of these transport costs, so going from $1,000 a container to $10,000 a container, is going to keep rising, that's where you're going to get inflation from. If it's a one-off or it's a situation that's occurring and that's going to, even if it's just going to flatten and not go up anymore but stay at this elevated level, like that's not inflationary. Going forward, you get like this one-off burst of inflation, but now you need that to keep rising if you can have inflation keep rising. And that's the part I guess I'm arguing is that, look, I think there's definitely some short-term, we've seen, I'm not trying to deny there's short-term inflation and we're seeing these price pressures, but I can't see any of those price pressures where I look at it and I say, yeah, that looks like an entrenched thing that's just going to keep rising and it's going to stay embedded in it. I do think we're going to need more government support to actually get to that stage, and we might get there, but I don't think, given the current settings, that we will end up with entrenched inflation and mainly wage rises. I think.
Well, it's interesting because I think the wage rise question is the really critical one, right? And it's interesting in the UK, they expect to announce in the budget tomorrow that they're going to lift the minimum wage quite substantially to try and actually deal with some of those things. And I was reading today a piece of research that said over the next 6 months, quite a few people are looking potentially to try and switch jobs in Australia, right? And they're doing it because they think they can actually get a wage hike by moving. And there was some research published earlier on, I think from Treasury and the Reserve Bank, that said actually people moving from one job to another is actually good for GDP.
Right. Well, what was the basis of that? Was just that they get higher wages, is it?
Correct. Exactly. So that it flows through and they spend more and all of those sorts of things, right? Yeah, tenuous, I felt, but they did actually try to go into some detail to explain why this was a good thing. And the other interesting question is the energy question, right? Because
before we talk wages, one more thing on wages, because actually, this is one I want to throw out to your readership or viewership, because I'm actually really interested myself in terms of trying to work out. Actually, just give me 1 sec. I've just realised I haven't plugged my laptop battery in. I'm just going to be 1 second.
Okay, no props. I'll let you sort yourself out. And
I'm back. That's all right. I just noticed it was starting to run down.
Better that than you suddenly disappear. I had turned the counter on a few months ago, and he suddenly disappeared. Right, and he said, "Oh, I forgot to plug my laptop in."
Yes. So there's a survey out that looks at job satisfaction. And what I found fascinating with it is you look at the over 55s and job satisfaction But the last 2 years has been, I don't know, 80%-ish. It's been up and down a little bit, but it pretty much hasn't changed. You look at the 35 to 55s, and it's a little bit lower, and it started to fall away in the last 2 quarters. So it's sort of fallen from high 70s to low 70s in terms of job satisfaction. You look at the under 35s, and it is dramatically fallen away in the last 2 quarters. And I think it's fallen from, let's call it 70-something% where it started to maybe 55. But it's just been and it's not a pandemic thing insofar as when the pandemic hit and the first stage of the pandemic, job satisfaction actually rose for a lot of these employees. It's really only been the last 6 months where, I guess, in a lot of, and this is a global survey, but I think it applies to Australia as well, is that whole job satisfaction and the idea that younger people are a lot less satisfied with their job, in the last 6 months than what they used to be, which is what's driving a lot of these quits rates. So I don't know if you've got some thoughts, Martin, on that, but I'm fascinated to see, because I still don't. I can see some reasoning behind it, but the difference between the ages is just incredibly stark to me.
Well, I think part of it might be, and again, it comes from some of my surveys, that the last 18 months has been a bit of a wake-up call for some people, and asking themselves, well, what do I really enjoy doing? What do I want to do? Do I really want these long commutes? Do I really want these full-time, commitments? Are there other alternatives, right? That seems to be so I think some people are having their normal model of work challenged by what's happened over the last 18 months, and people are beginning to wake up to the fact, well, maybe there are different models of work. I mean, virtualized or part-time or different things, which is actually definitely hitting the lower age range much more than the upper age range in my surveys, right? Now, some of those people who are up the age range are still thinking, well, maybe I'll try and see whether I can find a role, but it's more within the domains that they know. Whereas further down the age range, it looks to me as though people perhaps are more open to different opportunities and even, breaking out from the industry that they're in into some area. So I think that's part of it. So there might be a psychological aspect to it as well as a financial aspect to it.
Yeah, well, and I do think there's that part about life's too short and all, and also that you might have been happy to work at a cafe, for example, and earn a certain wage, but now you've suddenly realised, just a minute, not only was I, do I want to go back and earn that same sort of quite low wage with the threat that I could be sent home at any time and just not get any more hours for weeks or months on a time, versus going to work for somewhere, say a call center where, something happens and we go into lockdown, you're like, yeah, okay, that's fine. I can still work from home. I don't get, so I get that part. But I guess what I'm wondering is, if this is a one-off, that, a bunch of people have rethought about their life and what's more important to them, and it's a big, there's a big change happening over the next 6 or 12 months, then that'll flow through into numbers and wages, and there'll be some effects, but it's that one will be sort of transitory, not structural. But if it ends up that people are, job hopping now, looking for meaning in their life, or that they're happier, I guess more importantly than that they actually say, you know what, I'm just going to work 2 or 3 days a week, because this is not, that's all I want. I can get enough to do whatever I want and surf and,
what's important, what's really important, right?
Exactly, because if that happens, and those people still want to consume, then maybe we do see some sort of more steady wage rises, because companies just have to start putting up wages in order to drag people back from the beach, because it's sort of saying, well, for $70,000 a year, no, that's fine. I'll take 2 days at the beach, but if you pay me 120, then maybe I'll work 5 days for you. Yeah.
Well, I actually covered some of that in my earlier post today, so people go and have a look at that.
Right.
Not now, but after the show, because it is quite interesting. That research is actually quite interesting in terms of just watching some of those dynamics. But let's just come on to the energy. Cookie Boy a little while said, what's your thoughts on oil? JP Morgan and a few other economists see $100 plus a barrel price. How will the market react? We know Putin is saying, yeah, sure, we'll pump a bit more oil, right? We know that gas prices have gone through the roof.
Yeah. So let me paint this picture, and it's actually quite a complicated one. So I'll do the thumbnail one, but I might need you to get me to zoom in if I miss any of the miss any steps. The way I see this energy playing out is there's two main areas where it's playing out. One is in China, the other one's in Europe, and they've both got similar they've got some similarities, and the main one's Russia, but they are different in their own ways. So in China, they've had a number of accidents. They've obviously not taking Australian coal. They've had floods in the areas where they're doing coal mining. They've had water shortages in some of the areas where they do hydroelectrics, and all those are sort of gone into sort of this sort of perfect storm, as you've had this supply push in from we spoke about the extra manufacturing. People aren't spending money on travel, and so they're spending it on manufacturing, and that is what China does, is manufactures all these things, and most of their electricity goes to manufacturing, which is different to other countries where most of the electricity goes to the retail sector. So China's been affected by all these things all at the same time. In the meantime, they've really ramped up their own coal production, so they've tried to get a whole bunch of mines moving. They've been shutting down factories and only letting them run at certain times. The other thing was they had the border closed to Mongolia, which is a big importer of coal, and that's now opening up again. And Russia, some of the supplies from Russia hadn't been as big as what they'd expected. So that's sort of on one side of the planet. And so I can see where there's a bunch of short-term things going on. Again, the big question is, does this manufacturing boom keep going? Or does it turn back into, as people can travel more, they actually go out and start spending more on travel and less on manufacturing? And that's our base case, is that's probably what's going to happen. But that's your upside risk, is that. Or a cold winter. Actually, the other thing is, if we get a particularly cold winter, then you could easily see these prices spike even higher. So, but it does look like you've got a sort of 3 to 6 months worth of before you can, at most, before you start seeing those prices fall back to more reasonable levels. In Europe, my take is it's a different story for. In that they've had a similar thing in that they haven't had as much wind as what's expected, and so that's sort of brought the level down. To me, the bigger effect, though, has been what's going on with Russia and Russian gas. So I've got a chart there, which I'd love you to bring up, which is showing Gazprom's flows into Europe. And so this is what the black line is what they usually do. What they did last year. And then the pink bars are what they've been doing so far this year. And you can just see this massive drop away over the last 3 months, which coincides with they finished a new pipeline, which the Nord Stream 2, which basically cuts out the Ukraine and cuts out Poland from Russian gas. And so they don't have to pay tariffs to either of those countries to get Russian gas into the rest of Europe. And so this pipeline hasn't been signed off yet. So the European regulator needs to sign off, and in particular, Germany needs to sign off on the pipeline. And I think let's just call it all fortuitous that we'll assume that this is, that there are genuine reasons for Gazprom, giving less gas. But, Putin's certainly standing up and saying, if only you would just approve this gas line, then I'm sure we could sort everything out. And so is it just luck that all those happen to fall? Maybe it was just serendipitous for the Russians. Maybe there's something more in terms of it's just they're applying pressure to actually get the their pipeline approved and cut out Poland and the Ukraine from well, there still will be gas going through both those, but they don't need to send as much through those anymore. They'll be able to send a lot more down this down the one which basically runs through the sea there, so that they don't have to pay any countries to get it to Germany. So I'd look upon that and say, well, both of those seem again like transitory issues, which will then bring those prices back down again. So that's the energy side. But a cold winter would could easily throw that all out. Then because supply is limited in these areas, God knows how high the prices would go if you get a particularly cold winter coming through. Mm. Oh, and the other one you've got is a La Nina looks like it's coming through. And the last time we had a big La Nina, it parked a cyclone over Queensland and flooded most Queensland, and which meant all the coal mines couldn't send out their coal, which meant coal price went soaring. And so that's there's genuine weather risks to energy prices, but it does seem as if again there's reasons for them spiking to where they are that don't look like reasons why energy prices are just going to keep rising year after year after year from here.
Yes, and interesting again in the UK, they've got a very high fuel price at the pump, of course, for a lot of shortages because of lack of drivers as well, which didn't help.
Yes.
They also had massive issues with the price of particularly gas, because of course the price has gone very high, and that's put a lot of energy companies basically out of business.
Yes.
And as a result of that, they've got this fallback scheme, which basically means that another company will pick up effectively the supply and make sure that people don't get cut off completely, but they're having to carry the losses, right? Because essentially, the whole thing is they've basically messed their own market up so badly that it's not a market anymore. It's a completely controlled mess. And again, it could well be transitory. It could shake out. It could be that prices continue to ease. But it is messy, and then of course that flows back round again through the inflation discussion, and on it goes. Exactly,
and does that then mean that this price, are these? The question for these prices again are, there will be some echo effect when you get energy rises. You then get that sort of flow back into higher transport costs, and that then flows through to higher wages, and and then it can circle back around and keep going. But the issue for the overall price is, are these gas prices and coal prices at levels where you're going to keep seeing them rise year after year? So if you think that the European gas price has gone from whatever it is to sort of 10, 12, oh, sorry, actually no, it's more like the European gas one's gone from sort of $5 or $6 a BTU to, I don't know, 30, 40? I mean, it spikes.
It's a big spike, yeah.
It spiked maybe even 50, I think. But yeah, it's certainly spiked higher. And so the issue is it going to keep rising? Are these fundamental reasons in place that you think it's going to keep rising? Or is this something which could actually be cleared by once this pipeline gets through, once the weather patterns sort of move back to a more normal? Does that happen? And then the question is, what does Europe do about it in terms of are they going to invest in a whole bunch more capacity? And I'm guessing that it's not going to be. They don't want more reliance on Russia. This is sort of like a good reminder to them that no, we'd actually prefer not to be completely reliant on Russian gas. And so whether it's nuclear power, whether it's more renewables, there's reasonable argument that particularly as Europe's pretty invested in the whole net zero, is that the net effect of this is actually a bit of a push into renewable energy, and which will then bring costs down even further. So going forward.
And it's interesting, Cookie just mentioned this, I'll just bring it at this point. Interesting, the NT government considering building a solar farm and exporting the power to Singapore, right? Will super funds buy that? It's interesting, because you can start shipping this energy around, right?
Yeah. Now this is an interesting one. I've done a lot of work on solar power. This is one of my, 10, 15 year obsession with this idea that solar power is sort of dropping away in price every year, and it's on this technology curve. So every year it just comes down, 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 and it's now it's the cheapest source out there, but obviously the sun doesn't shine at night, and so then you've got this issue of saying, well, solar plus battery though, that does give you it, and the cost for that is doing the same thing, but it's still higher than the cost of coal or gas at the moment, but it's coming down and it's not far off reaching in sunny climates to that point. Now, I don't completely understand the economics of shipping it to Singapore. I think there's some short-term issues with it, some short-term benefits from a cost perspective. I don't think the benefits will be there over the longer term. I think that it will be cheaper for them to have, whether it's floating somewhere closer or whether it's something with battery, something that uses more battery power will come in. So maybe it does get up in the short term. The thing I wonder is why they don't ship it back to Sydney or Brisbane, because the big issue is if you're in Sydney, you want to run your solar power is cheaper during the day, and you're even getting sort of negative prices every now and again during the day because of, or certainly in Melbourne and Adelaide, I think you are, because of the solar power, how cheap it is. The benefit of the Northern Territory is when you're pumping solar power in the afternoon, it's the evening in Sydney and they can't use their solar power anymore. You can actually be shipping the energy back east. So that's where there's actually a genuine, more of a genuine case, I would think, but we haven't seen that yet. So, solar power, absolutely. Keep watching that curve come down is my take on it, and watching the solar plus battery as well. Be a big issue.
But the interesting question just on that: the transmission lines, when they're long, of course, takes a lot of the power out of the system, right? So
exactly.
By definition, the very large land masses that we have makes it hard to ship, electricity from one end of the country to the other end of the country. It's not like oil; you can just pump it, right? There's a resistance curve.
Yeah, that's right. And what you're trading off is the cost of the battery versus the cost of the transmission. Yep. So do I have it closer to Sydney and then to store it, or do I have it further away from Sydney and then take advantage of the sun moving across the planet and ship it back? Right now, the transmission cost is better. It's cheaper than the batteries, but the battery cost is falling at rapid rates. Yep. And so actually, I haven't done the maths on that one, but my guess would be, it'd be within 5 years, you'll be at the stage where you're saying, okay, now it's no longer worth doing that, because the transmission technology is pretty mature. We've been transmitting electricity around a lot. We're not getting the same. You don't get the same drops. So you really do need this. You really need that battery power to be economically worthwhile. So you can do it right now with subsidies, but obviously you can't run your whole system on subsidies. You do need to get that cost down, and it is falling. So I fully expect that over the next in 10 years' time, everyone will be wondering why we ever had this debate, because it's obvious now that batteries plus solar is way cheaper than all these other forms.
Well, we might towards the end of the conversation perhaps pick up some of the the announcements over the last couple of days with regards to 50 and all of those things. But let's not go there straight away, right? No. Otherwise, we'll get ourselves sidetracked. Yeah.
Do we go quickly to oil, because we didn't talk about oil? I was going to say let's just go back to oil. Yep. Yeah. So $100 oil is clearly possible. Let me think about so easiest way to talk about this one. I think that there's a common thread out there which is talking about ESG has ruined all these carbon. We've got all these shortages because people who don't want to invest in things anymore, and that's what's driven this shortage. I don't believe that because the decisions, most of the big offshore ones, which is where we've most of the oil and gas has come from, they're 20-year life cycles at least, an investment cycle, sorry. And if you could get one of those on in 10 years, you're doing a fantastic job from discovery to production to all that type of stuff. So that ESG is absolutely affecting those, but that's not affecting the supply of oil for another 10, 20 years before that's happening. The US shale, though, where there is lots of scope for them to the life cycle there is much faster. That's more like 2 or 3 years. And so the thing that we're seeing within the US is when prices go up, shale oil comes flying back, and that's what we're seeing now. Is that that really is the drilling is really starting to pick up again there, and there are other countries that have spare capacity. Probably, the OPEC always talks about how much spare capacity. It is very hard to tell, but what we're seeing in terms of that energy market is now, in terms of the oil market, is now a trade-off between will people. So we know that people are going to drive more than what they used to drive. Or in terms of they're going to catch less public transport than what they used to. It seems to be the primary thing coming out of the pandemic. Maybe that'll ease off later, maybe it won't, but it probably means more people in cars. What we don't really know is, does that get offset completely by more people working from home and not traveling as much, or does it actually end up being a net gain in terms of more people work from home but they also travel down to their local shops or do whatever, or the extra driving they're doing. So that's a big question, and also the turning back on of travel. Plus, we know the oil is manipulated because Saudis are holding off supply and others. So I guess it's a long way of saying I'm not taking any massive bets either way with oil. I'm just sort of saying, well, look, I can see where shortages could happen. I don't think over the longer term there is a shortage, because I do think the electrification will gradually start to eat into that market over time, and I do think there's enough supply within existing countries and existing oil wells, and enough supply within the US that can be turned on relatively quickly, within a year or two, that will keep the oil price relatively range bound. But in times where we've seen the European gas price up 1,000% and 300 or 400% in coal prices, saying that the oil price couldn't rise another 20% from where it is now, is I think would be incorrect.
Yeah, well, and energy is an input, right? It's an input towards everything. So if you want another force that might turn inflation into something more sticky, look here, I think, is what I'd say.
Yeah, that's right. But again, it comes down to that sustained part. If you think that, because most of the shale guys in the US at $50 or $60, they will pump as much oil as they possibly can, and they've got a lot there. So $100, they will be hand over fist. They'll be dragging people out of McDonald's to stick them on the back of a drill to try and drill just as much as they possibly can in Europe. So in the US. So I do think a short-term spike at to $100 would have a big supply effect.
Right. So
it
would bring more back on, is what you're saying, right? So
yeah, that's right.
If the price went up, more people would say, hey, it's profitable, I'll now produce more.
Yeah. And it'll be interesting to see coming out of the climate change talks later on this year, which whether if we do get some general consensus over some cuts to 2030 and net zero 2050, then at some stage you would have to think there's some countries who within OPEC who will decide that, if I don't pump this oil now, I'm never pumping it. So I'm going to try and get it out as fast as I can. And so, there is a supply, potential for more supply from that. And then look, even from an environmental point of view, it actually makes sense for us to say, well, rather than going drilling new oil wells to get this extra demand, why don't we run the ones we've already got dry and then not just never drill those other ones? So
I love it. All right, let's move on the conversation, because the other Mirage is the China Evergrande, China property,
Yes.
Chinese economy question, right? Is Evergrande just a little blip? The central bank in China said, no, we've got everything under control. Don't worry about that. I mean, they did actually manage to conjure up some payments, so they sort of missed after up to the end of the 30 days. But there's more risk of default. And Evergrande is just one example of what's happening in the property sector more broadly. The property sector in China is a huge proportion of the total economy in terms of GDP. Is this something that can be contained, or is it really a Lehman moment? What do you think?
I don't think it's a Lehman moment. Well, it's probably not a Lehman moment. I think there's the big issue with Lehman when it was allowed to go broke was it was interlinked with so much of the rest of so many other banks that didn't even know they had exposure to Lehman, but it was sort of through third parties and everything like that the whole system sort of came to a halt in terms of everyone was like, I don't even know I don't know how much I owe, I don't know how much people owe me. The property sector is interlinked over there. I do think they're going to try and manage the slowdown. The Chinese property developers, are 50% larger than the rest of the world's property developers put together. So, and they know they're overbuilding, and so they will bring that back. They're using the big boom in manufactured goods that we spoke about earlier on. So there's this huge boom in industrial production in China. They're using that to actually slow down in the property sector because they can transfer people out of property sector and into these industrial companies. So I think that's all going on. This is just the tip of the iceberg. There's 7/8. Evergrande's, it's big, but the other 7/8 of the sector is sitting below the water, and there are other Chinese property companies that are defaulting on their debts, particularly to foreigners. I don't think there's been too many local ones at the moment. It's more about, yes, we can default on the foreign debts and we'll try and pay the local ones where we can. So I do think they will. I do think they're quite serious about transitioning this time. There's an argument out there which is basically saying, look, Evergrande's too big to fail. China's going to have to step in and sort it out, and then they're going to have to stimulate and spend more money, and so commodities will boom again. I think that's probably, there's a reasonable chance that will happen. My feeling though is that they've tried this 3 times, and they will at least try as hard as they did in the last 2 times, or the last 3 times. And what that meant last time was a sustained slowdown in the property sector before they finally gave up, and then threw a whole bunch of money to try and get to re-get that sector going again. I think there's some time to run, and particularly because they have this cover of, there's never been a better time. Well, the better time actually was probably, it has been better time. 15 years ago was a better time. It's not to blow the bubble in the first place, but given where we are today, it's not going to be better in a year's time or 2 years' time. You've got this huge industrial boom going on right now. Now is the time to switch, and I do think they'll take advantage of that. And so keep in mind that the largest consumer of commodities in the globe is the Chinese property construction sector. So there will be dramatic falls in the demand for all these commodities, and there's a bunch of commodities being held up at the moment by I don't know. I guess it's a mixture of hope and also the fact that some of the refining shut down. So copper, for example, comes into the copper ores coming into a refiner. The refiner's shut, or they're only doing 2 or 3 days a week because of this energy crisis in China. And so the end price for copper is shooting up because the actual refined copper, there's not much around. But that's not saying that there's a huge demand for the original copper ore. That's saying there's a demand for the refined copper, which is not being met. And so I'm sort of, if you want to play those and trade some commodities, go for your life. You get in and get out. You can double, you can halve pretty quickly. But as a longer term view, I look at inflation-adjusted prices over very long periods of time, and commodity prices just fall. Over 10, 20, 30-year periods, in real terms, commodity prices keep declining because we keep getting better at digging this stuff up and processing it. And so, and we're at all-time highs. So I'm just sort of going, well, I can see where the shortages have happened, but it's been a short, sharp, driven by the commodity, driven by the whole Chinese construction. And if that comes off, then there's significantly less demand, and also more recycling in China of metals as well. So,
well, we've certainly seen BHP, for example. Their share price has come back a reasonable way, mirroring the fall in the price.
Yeah, and actually, when I was saying that with recycling, it's actually right now there's actually less recycling going on because recycling uses a lot of the electricity. It's quite electricity intensive, but when so that's sort of helped cushion the blow. So, but when they do restart some of that scrap, then you can sort of expect to see even less demand. And I think we showed. Did we talk about last time that there's a great video out of that 15 buildings all being knocked down in China?
Yes. Yep.
And that's where there's a lot of steel within those. They knock them all down. They take all the steel out, and that's where the primary source of recycled steel is dragging them out of those. And
some of the buildings they're demolishing are half built. They never completed them.
Yes, or just as bad, they built them, just nobody ever lived in them.
Yeah. Exactly.
Yeah.
Oh, well, the numbers are stupid, right? So, I mean, my perspective is that we might well see some changes after early November. There is this big Chinese discussion, right? And basically the next wave of political decisions will be taken then. So I wonder whether some of what's happening is being done because of that short-term political environment in China at the moment, and maybe we'll see some differences after that. I don't know.
Yeah, possibly. And the other thing to note as well, just in terms of timing in politics, is that they traditionally they'll set their budgets for the local governments at on an annual basis, and so and the local governments haven't been spending as much as what they thought they were going to spend, and part of the reason is because they're not doing their land sales are down. China's very what you call pro-cyclical, in that when property prices are rising and then local governments are selling their land to the developers and taking that money and using that money to go and put it into infrastructure, and then so the whole thing sort of spirals up. But when it goes in reverse, the opposite starts happening, is that the land sales are down, and so now they haven't got the same amount of money to go and spend the money on infrastructure as what they used to. And so next year we'll see some new budgets from sort of January, February. And so that'll be the interesting part about going, if we're in for a real if they're genuinely serious about transitioning away from property and into these other sectors, I think that's when we'll really start to see the, how serious they are as to how much local government borrowing goes into that sector.
Well, they certainly are talking, it's hard to understand precisely, but they're talking about, leveling up, some people got really, really rich, but that, they need to tilt it back a bit and spread the love, as it were. That does seem to be one of the themes that's coming through from China at the moment. And if that political tweak of the tiller follows through, that could be quite significant.
Absolutely, but keep in mind as well, China, the household ownership is very, very high in China. So they want to keep property. They don't want property prices to fall, but they do want developers to stop building more property. And so it's an interesting sort of play on how they're going to try and manage that dichotomy of going, well, we don't want prices to fall too far because we have so many people owning property. But the flip side is,
sounds familiar,
we don't want to yeah, exactly. And it seems as well a lot of the stuff they're doing is intelligent stuff. So I wish some other countries, like, they're looking at putting property taxes on. Like, that's a big saying, okay, that's a good thing because it'll help even out the people that are very rich or do own multiple properties, can start paying property taxes. And if they want to build them and leave them unleased, then just have them there, then we'll make them pay for it. And then until they go, oh, well, actually, maybe I will move somebody into that apartment. So yeah, let's see. Who knows what other countries might decide? That's some of the things China's doing are might be good for the more even wealth spread in the property sector.
Yeah, absolutely. Well, let's come back home. Now, the Reserve Bank over the last few days has been buying bonds big, right, to try and keep its target yield curve control in place. And it's interesting that there was this chart, I think, came out today, which is the 5-year inflation-linked swap rates for both the euro and the US. And basically, they've taken off, right? And they're now significantly higher than they've been for quite some time. And that perhaps suggests that maybe the underlying trajectory of interest rates is actually up. We know that New Zealand has lifted rates. We know that several other countries around the world, including Iceland, have lifted rates. There's talk about the ECB lifting rates soon. So the question I've got is the RBA going to be able to keep its yield curve control in place and keep rates where they are until 2024 as it desires? Or is the market ultimately going to steamroll them into doing something, lifting rates sooner, with all the consequences of that happening?
Yeah, look, coming back to what I was saying at the start is that, they have got a review going on. If commodity prices, and in particular, iron ore and coal, end up shooting back up again, then the RBA's got to... then there'll be more money coming in. We could see more of that getting out, and immigration stays low, and we actually see wage growth coming through. Then I could see reasons for the RBA to raise rates earlier. I don't think any of those are happening. I think the commodity prices will fall back. I think the hope. Well, I think both sides of government, I think, will throw open borders as soon as possible, which will probably put some limits on wage growth. And what that ends up meaning is that Australia is probably going to be one of the last ones to need to raise rates. And so, so I guess I look at the RBA and say, well, I don't think they're going to need to hose this off. I do think we'll start seeing the growth come back. I think a lot of the recent pressure, particularly in currency wise as well, has been the shoot up in the coal prices. So could that mean that we go through a particularly cold winter and maybe one or two other things go wrong, and could the coal prices double again from here and maybe they get even more pressure? Then yes, that's absolutely a thing. But I think if they did that, it would be a mistake. If they start raising rates or even tapering too early, I do think that would be a mistake, and it'll come back to bite us in 6 to 12 months' time anyway. Does that answer the question?
Yes, okay. So basically you think the RBA's got it all under control, the markets won't win, and what happens if the Fed starts doing its quantitative easing tapering and then subsequently starts lifting rates? Does that change the picture?
Look, what's interesting is the Australian rates really have priced themselves at the long end, really have followed the US as much as anything. And if the cycle is going the way we expect, is that China's slowing down, commodity use is slowing down, then you would think that there would be a disconnect at some stage between the US and Aussie rates. Like we've seen, there was a disconnect happen between the US and European rates, 2 or 3 years earlier, where the growth was so slow in Europe that we ended up with all these negative yields in European countries, but the US was still quite significantly positive, and so was Australia and Canada and New Zealand. But my expectation is there will be a disconnect at some stage between, and you'll get that separation between the Australian and the US rates. But right now that hasn't happened. Yeah, the Australian rates seem to be very much connected to the US, and it will be a question about saying you will need to see that China slowdown keep occurring and commodity prices to fall away for there to be a disconnect. Whereas if the other thing did happen, if China turns around after this meeting and decides actually things have slowed down too quickly, we're about to throw a whole bunch more debt at the property sector and get it going again, then they're right. Yeah, Aussie dollars off to the races. interest rates are going up. It's sort of back to more of the same.
Actually, that's a perfect segue, because RC asked about the US dollar and how that all plays off. And the point I'd make is that the exchange rate will be where the action is, right? Because effectively, if the Fed really starts to push the accelerator and Australia doesn't, it's going to hit the exchange rate. And actually, the Reserve Bank would like the exchange rate lower.
Yes, that's right. So so basically, whichever central banks are going first are the ones where you'll probably see their currency headed up first. And so we're expecting that China is going to be one of the last ones out of this slowdown. Australia will be affected by China. Europe sort of is it next least worst or next worst. Well, no, the worst it, and then the US is quite a way in front of everyone. So so I do think that they're the fastest out of this, and so more likely to see the currency higher than in other countries. And that's the thing to remember with currencies. It's very much a relative game between which one's improving faster than others. That's the one that's most likely going to have the stronger currency.
All right, let's talk about one other mirage, and that is the tech sector, right? Because the end of last week, we had a significant fall in, for example, Facebook. I think they dropped nearly 5% in one day, and that was because there were a whole bunch of concerns about more regulation and various things. Facebook's come out with their results, massively strong results, now taken off again, right? And now everyone's saying, oh, the tech sector's brilliant, it's going to go on forever and it's going to continue to boom, right? The tech sector is such a large proportion of the US market now. And of course, Tesla's shares over the last 24 hours shot up because Hertz is now going to take a whole large order of electric cars from Tesla, right?
Yeah.
So what's your read on the tech? Is there still more runway? Is it still going to go higher?
Look, I very much look at tech in a number of different buckets. So there's some high tech, some high growth, unprofitable technology stocks, and they're the ones like your Teslas and other ones that are growing very quickly, but aren't making money or aren't making anywhere near as much money as what you need to justify the share price. So it's all about the growth for those stocks. They're the ones that got priced up the most and tend to be the most volatile in terms of this. So if you do see a slowing, well, actually, they're the one they're going to benefit the most from a weaker economy and lower interest rates and being the only good growth story in town. But the flip side is, if inflation gets away too quickly and things start rising faster, then they're the ones that are going to get punished the most. I tend to like the ones more like your Microsofts and Googles and we've got a bit of Facebook as well and some other ones in that space where they're actually not that expensive relative to the rest of the market. They're probably 20% more expensive than the rest of the market, but growing much stronger than average. And they're real, they're profitable, their earnings just keep going up. Particularly some of the ones involved in some of the cloud computing and everything. There's just, I can see years and years and years of genuine cost savings for companies as the companies switch their products up onto the cloud. And so, and the productivity benefits that companies get are significant. I can just see it's a win-win for everyone, the customers, the consumers, the operators. So the profitable tech side, which is sort of I'm quite positive on, the semiconductors is a little bit, look, it's a very cyclical sector. And so you do need to keep in mind that they go through these, you get shortages, you get these waves of CapEx, and when this huge wave of CapEx at the moment that's going through, and that inevitably leads to too much, and then you end up with lower prices, and then you start the whole cycle all over again. So the semiconductor side, which is a very large part of the US market, you need to be careful about when you're getting in and when you're getting out. I don't think it's quite time yet to be loading up on those. So so the part of the tech sector we've been headed for is the more profitable part. But we haven't been buying more at this point. We've sort of been more, taking some profits. If we get a decent sized market pullback, that's exactly where I'm going to be putting money. So, not to say, it's not to say I don't like the sector in terms of we do own a decent chunk of them, and a good sized market fall. That's where I'll be looking to allocate. Right now, look, you draw the bullish scenarios, which your bullish scenarios basically say that China is relatively contained. The European, the inflation starts to come off. You start to see some wage growth, more government stimulus, or just everything goes the way it's going, and company earnings start to tick up again. Then the tech stocks are probably going to do quite well in that in that environment. So if you can get earnings growth in this market, then certainly it's a very helpful thing for as you look.
Vanessa makes a really good point. I thought the supply shortage would affect the tech sector. We certainly know that Apple's basically saying they got some issues with some of the chips and things that they need. So that could be something just to bear in mind.
Yeah, exactly. And very much depends on what you're looking at, though, doesn't it? In terms of the supply sector, will definitely affect those ones. But if you've got a software producer, then that's really not affecting the software producer in terms of what's happening. So the shortages are. The other thing to keep in mind with the shortages is a lot of it depends on how expensive your product is. So a lot of the problem was that the semiconductor factories are sort of set up to run these lines, and the auto sector, as one good example, had booked a whole bunch of these lines and said, this is how much we want in chips, and then they cancelled them all at the start of the pandemic. They said, no, we don't need them anymore, and a lot of those were quite low value ones. So the chips that run your electric mirrors or move your seat back and forth, they're not high end chips, and so when all these cancellations came through, at the same time we had suddenly right around the world everyone wanting to buy new iPads and laptops for people at home and all these other things. And so the semiconductor basically reconfigured their lines to start doing more laptop semiconductors and more for all these other consumer goods, which are much higher, generally were much higher margin as well. And so when the car companies came back and said, oh, actually, you know what, made a mistake, I actually do want all those car chips, they genuinely said, well, we've already converted the lines, of course, we just don't have the capacity anymore. And they don't really have the desire as well to go, well, do I change from some of the higher value ones back to lower value ones? And so there is a new supply sort of coming through as people are building, but I guess what I'm getting to is, if you're running higher value products, you're more likely to still have, you can command, if you've got a $1,500 product, then and the cost of your chips goes from $100 to $150, it's really not making a huge difference to the overall package. Whereas some of the other, less important items that does affect a bit more.
Absolutely. Yeah, it is interesting. And, the other point, of course, with the tech sector is those that are still in growth phase are going to be determined by future interest rates, because they discount the value of future revenues based on the yield curve and interest rates, right? So if interest rates go up, they become less valuable.
Yeah, all else being equal, I guess is probably the key one there.
Yeah.
So if you're seeing some strong growth, then in strong economic growth, if we're getting productivity gains, strong economic growth, then companies can weather higher interest rates, because they offset. They sort of go, interest rates are higher, which should bring the valuations down. But on the flip side, earnings are higher and earnings growth is higher, so it all nets out. Where you see interest rates rising, though, and without seeing that same follow through on the growth, that's where they get punished the most. And that was what benefited the other direction, was when we saw interest rates falling, that whole tech sector really boomed with the idea that, earnings growth is actually still pretty good. And so if discount rates are lower, then they're going to do even better from a valuation perspective.
Oh, well, let's go to one last mirage as we get to within the last 5 minutes or so of the show, and that is, of course, the announcement today of the net zero by 50, right? Okay. No,
you're not saying it's just a press release and there's not real. They haven't done like real modelling and 10 years worth of real work, are you?
I was going to say, has it really made any difference at all? I mean, it's, to my mind, it's just sort of very, very high level. It allows him to fly off to Europe and not look completely out of kilter. But, has it really made a difference?
Look, I didn't buy or sell anything today based on the announcement. No. Look, what does it mean? Look, I mean, it means something. As insofar as press releases mean things, I think there's a certain element of saying, if there's companies out there that were planning to do things, and they could hide behind the cover of, well, we haven't, Australia hasn't committed to any of these things, so therefore I can keep trying to do the things I want to do, then maybe that at the margin that helps. The reality is companies got on with it years ago. The companies realize what's happening, realize they need to make changes. All the big ones that are multinationals, they had other jurisdictions putting on things, and so they went, well, if we're going to do it elsewhere, we may as well just do it in Australia as well. I think the corporate sector is, most of it has moved on, and maybe this will be a slightly help at the margin for some of the more recalcitrant elements in the corporate sector. But look, it's probably not enough to get them to change their ways anyway. They probably need regulation, and I don't think there's a lot of. I think let's put it this way: what struck me is that the current government loves carrots, and they're not that, but for companies, and they're not that keen on sticks. So, whereas I think companies need a bit of both, as do we all. And so I think saying that we're going to go out and spend money and support new technologies and that'll solve all the problems is I don't think that's the right way to do it. I think you need to have a mixture of both. So until we actually see what that's going to be, but certainly they've addressed that, there's going to be a pot of money. So anyone who wants to put their hand up and trying to win some things, you can also donate to your favourite political party.
Exactly. Well, it's interesting because 40% is banking technology, which may or may not exist, right? Plus another 15%, which is basically saying there'll be another technology we don't know about, which will help as well, right? So basically, more than half of the plan is actually based on technology which might or might not exist, right? And you're right. Basically, it's very much about saying, well, we're not going to force people to do things, right? I mean, it just feels to me very, very light hand on the tiller. But you're dead right. The markets are already pushing, right? From BlackRock, big investment. People are actually making decisions based on the story of how people are dealing with this. And I actually think it's going to be the market pressures ultimately which will drive this. It won't be necessarily the political environment at all.
Well, in Australia, yes.
Yeah, in Australia.
In some other countries, it is. It is help. Europe in particular is driven from the politics, and the companies pick up on it and do it. But I think Australia is very likely to let companies take the lead and just follow. Or the states, I mean, obviously, the New South Wales has put some excellent policies through.
I was going to say,
and so
that's the other story, isn't it? Actually, we're on track, wherever the track is, thanks to what the states have done.
Yes, yeah, absolutely. And so, so it would be very nice to have a federal, consensus on this, and sort of at least, setting a lower bar for the states and sort of pushing them along, so that ones that aren't sort of as forward looking sort of have to pick up the pace a bit.
Yep.
But it seems as if they're sort of lagging a fair way behind, and so yeah.
Okay, well, we're coming to the end of the show, and I want to just pose you one final question, and that is, normally September and October each year is the wobbly part of the year from a market perspective, right? We seem to have got through September and October, frankly, better than I expected. So you think there's more upside from this point for the rest of the year?
Oh, look, it's tough. We spend... we can certainly see a lot of negatives. There's a lot of dark clouds, but it is a reminder about why you don't go to 0%. You should very rarely go to 0% in terms of your equity holdings, and you need to be sort of positioned and diversified in terms of portfolios to try and take advantage of both upside and downside. So, it's probably a good reminder for people in terms of, especially people who have sort of regular investment plans and things like that, is that the hardest conversations we always have with clients is people who turn up and say, I'm sitting on this nest egg of whatever, $500,000, $1 million, $100,000, $10,000, whatever you've built up, and this is all the money I have in the world, and I need to decide whether today is the day I invest or not. And you're like, well, that's a lot of pressure as to, is today exactly the right day? I think if you've got investment plans where you're saying, here's an amount I'm putting away every month, every quarter, whatever it is, that you can lean into the cycles and lean out of them, but you still, it's the idea that you're trying to stay mostly invested throughout the cycle and sort of lean in and lean out. And so, the question is, it's a long-winded way when you're saying, is there more upside in the market from here? Is I don't know. I could certainly see scenarios where the market would fall back based on what's happening in China and others slowing down. But if it and I'd be looking to buy at that point. If I got a 10% pull back in particular, I'd be starting to load up again on equities. And so the question is, if you're investing for long periods of time, do you hold off on that 10%, 15% possible fall to sit back and try and time the exact bottom, or do you try and just sort of say, well, look, let me just average in? I'll just sort of go, I might just get started at least, and with the view that then if a pullback does happen, I can then throw a bunch more at it if you need to. But that whole idea about trying to pick exactly the right time to get in is very difficult, and things change. And I'll come back to what I said right at the start again, and I'll try and say it at the start and at the end of everyone, is that we're driven by governments. It's political and political decisions that's really driving a lot of the amount of stimulus that's being driven into markets. And so you can take a guess at what's going to happen, but you can have things turn on a dime. And China could turn around tomorrow and say, yep, all this extra debt, we're bailing out all these property companies and we're removing the 3 red lines, and off we go. And the last hour of conversation is probably mostly wasted if they do that. So let's come back on again. But I don't think that's going to happen. But we just need to be aware that that's the environment we're in at the moment.
And 3 points to take out from that. One is it's very hard to pick the top or the bottom, right? And what you do know is that there will be movements up, movements down. I actually think one of the problems is having the daily stock price movements being reported. It almost overemphasizes what's really going on. What you need is to stand back a bit, right? Because over the medium to long term, equities tend to do quite well. And in fact, on the number of measures, I could still argue equities do better than property, but I won't start that debate now, but it's worth perhaps exploring sometime. Then the other one, spread the risks, diversification, is actually quite important too, because there are so many unknowns. And, in all the years I've been involved in investing in markets, I think it's probably as uncertain as I've ever seen it. So there's a lot of ifs and buts.
Yeah, and you spoke about mirage or not. It's this real dichotomy at the moment in so many different areas. We spoke about China in terms of the property. We spoke about commodities a little bit in terms of is it China back on, China back off. We spoke about inflation. We spoke about energy. Like there's a whole bunch of things that could go either direction. And so I've given my views as to the most likely path, but I'm in no way of saying I'm 100% this is exactly what's happening. I think this is the most likely, but fully aware that things can change, and I'm testing every day. I spend every day testing my assumptions. Like we keep seeing, I've seen a few pieces out recently about how great the reporting season is, and every time I see one, I'm rushed back to my numbers and just a minute, really? Is it a great reporting season? No. I still can't see it. I still can't see it. But it's that, it's the narrative. Markets get driven by narrative, and the you want to sort of identify where you think the narrative is largely right, and then stick with it, and where you think the narrative is straying away, and then start pushing back against it. And I do think there's some points at right now where the narrative is basically saying, no, China's fine, they'll sort it out, just trust them. And there's this stagflation coming, and there's this energy that's going to turn into, and we're back to the 1970s. And those ones, I'm saying, no, I think those ones are, we should be leaning into those. And but it's not it's not 100%. It's just saying lean into it. If you're wrong, well, the market might run up a little bit faster, but you've always got a chance to buy back at that point if you need to.
Yeah, and I would make the point that some of the people who are very vocal about things at the moment have a particular vested interest, particularly with volatility and trading and trying to persuade people to go down particular alleys, right? I always say to people, when you listen to advice, ask what's motivating them and why are they saying what they're saying.
Well, and I think as well, to me, there's a lot of Wall Street banks in particular that have really been pushing this idea that commodities will save you from inflation. And these were the guys telling you to buy iron ore at $200 and something because it's going to save you from inflation. And now, the iron ore price halves, and they're still out there trying to tell people, it's going to save you from inflation. And there's always a story about they will get people into the story at the start, and then they need to get those they get their biggest and best investors in at the start. They need to get those investors out, so they need to keep pushing the story, even though they're saying, the story is pretty long in the tooth. We'll keep telling people to keep doing it, so that we can get our existing clients out. Then, we'll start again.
And I actually do think that's really important. That sometimes some of the big houses are actually there saying one thing for public consumption, whilst doing something completely different for their most valued clients, and you won't know about it until it's too late.
Yeah, and I've obviously got interest as well. So I prefer people to invest in my fund than not invested in my fund. But the problem, as you said, with the transparency is you can see what I'm doing. So everyone can see that. You can jump in there and have a look at what we're actually doing and what we're buying, and know what we're telling you is the same as what we're doing in the background.
Well, as I said earlier on, the transparency was one of the reasons why I built this relationship, because I think it's pretty important. Damien, I want to say thank you very much. I really enjoyed the conversation. We didn't get through half the questions that people asked, but we never do. But hopefully people found that useful. Good news is you'll be back in a month's time, and we'll know what happened then, right? Another whole bunch of new questions probably will be there, but the mirage will continue. I really appreciate your time tonight, and we'll put all the links and things below as normal. So thank you very much, and have a great evening.
Thanks, man.
Great.
Thanks a lot.
Thank you. Cheers. There we are. Well, that was good. I hope you enjoyed that as much as I did. Damien's always really good value. Just to tell you that next week it'll be just me. I've changed my photograph, folks, so people didn't like the other one, so I've tried a new one this time. I'm going to be talking about household stress, my latest scenarios. We're rerunning the models at the moment. There's a lot of new data coming in, and I'll try and give you some early reads as to how I think people are actually behaving at the moment post the lockdowns. So that'll be next week. And just to remind you, in a couple of weeks' time, we've got Steve Keen coming on for a live conversation. You can ask him questions. And there will be, I think, a discussion coming on crypto in the next little while, as well as some of the other things too. So plenty more on the channel, and please like, subscribe, and support what we do. Very important to sort of spread the word as best you can. But I want to say thank you very much for spending some time with us this evening. Really appreciated it. And we'll look forward to seeing you next time, and catch up on the other shows during the week if you don't, if you can't wait till next Tuesday. There's shows posted every day. This is Martin North from Digital Finance Analytics signing off. See you next time. Bye-bye.